were just discussing the different types of insurances, if you want to go through it.
All right. Well, good evening to everybody. And can you see my screen, first of all?
Yes, we can see it.
Okay, perfect.
What's that?
You can see my lovely national real estate insurance group flyer on there.
Can you just zoom in a little bit? So that we can...
I'm so sorry. It's really hard to hear you.
Okay.
So if there's anybody that can get close up to the phone and translate, that would be fantastic.
Okay, can you just zoom in a little bit more?
Let's see if I can do anything else.
And just make it bigger, maybe, instead of it, enlarge it?
Go down to view.
View? And go to like a, yeah.
Yeah, let me get to my Zoom.
And hit zoom?
If we can.
Page width.
Okay, and you can, now we can see it. Once you go to that one, that's perfect.
Okay, great. Okay, so you can see this now.
Yes.
Okay, perfect. And then if I scroll, how's that doing for you?
Perfect. You got
Okay.
that? Yeah.
Well, we'll have a copy of it later.
Yeah. Everybody will get a copy of all these slides. They'll be on the website as well, okay?
Fantastic. Well, we can certainly start wherever you would like.
Yeah, first of all, let them know that you guys are located, where are you guys located?
First of all, we're located in Kansas City. We're about 4 miles from the airport, so we're easily accessible to anybody who would like to drop by at any time. We've been in Kansas City for a long time. Our president, Tim Norris, actually, he came to us from Ohio about 2.5 years ago, and the rest of us have been heavily in Kansas City. So, yes, that's us.
Can you tell us a little bit about how long you've been around and why you specialize with investors?
Yeah, absolutely. In terms of, the overall agency, which really the main name that people might recognize out there if they went to search would be WRENN, WRENN. And that particular agency has been around for 4 generations now. So we're, no new kids on the block here in terms of insurance in general. And then in regards to the program that is specifically for you guys as real estate investors, we've been doing that since '99, and you can text me on my screen here. And it really started from really insuring some of the guys who are involved with home investors. Probably some of you are familiar with the ugly house signs and all of that good stuff. And so we really started with a group of about 35 investors back in '99, and then it's grown to, I think, this last month, we probably are up to somewhere around 4,300 of you guys that we insure today, and then over 25,000 locations. So it's grown quite a bit since '99. And really, pretty much has, over this last, I would say, 2 years, pretty much doubled from where we were. So we've grown very rapidly.
Great. So the 3 types of insurances that we generally have, can you go over those and what they are?
Yeah, absolutely. First, as you're talking about coverages available, I guess if we go to that particular section on the screen, I have my little cursor out here. As we go to our lovely coverages available here, this can kind of help us in terms of, what types of properties we insure within the program, and then that'll lead us to, kind of the types of coverages that we've got going on. So one, first of all, you can see vacant property being held for sale. So That's pretty self-explanatory there, but after you guys finish your rehabs and have them sitting on the market, that's something that we easily do today. It can be difficult for you guys to obtain in the market at times for vacant properties, so that can be a good place to run to in terms of the program. The second, of course, would be a rental property. We got going on number 2 here. And of course, that is something that everybody is doing now, especially we saw a lot of change, of course, when the market dropped from a lot of people rehabbing, moving over to a lot of investors, really moving into longer term holds. So, of course, we've really seen a change in our book over the past 5 years, where primarily at the beginning of my involvement 5 years ago, we really had mostly rehab that we were insuring. And then, of course, about halfway through that really wildly swung over into, that longer-term hold market. So in terms of rental property, one of the great things about the program that's different than the standard market, for one, you got a little bit more time in terms of in-between tenants. We, of course, want you guys to make money, so we always want the property to be occupied all the time, of course, get those rents in. But at the same time, if you do, take over 30 days, it's not a big deal for us. A lot of times in the standard market, you may find that 30 days is sort of a limit that they have, and then all of a sudden they see it as a vacant property, and then sometimes they may not even want to insure it. I know that we've had some who have come to us from, let's say, a State Farm or what have you, that have had that experience, and, really they just need a few more days to get another tenant in there. So for us, you don't even have to change the occupancy status unless you go beyond 60 days. Which can really help. And then you can also, at the front end, too, have that same 60 days to get your first tenant in there, which saves you some cost in terms of not having to insure the vacant location. And then finally, of course, we're talking about our renovations, our rehabs that we're doing. In the program, you can do everything on a month-to-month basis, but that can really help, in regards to what you guys may be used to with the builder's risk policy, where you may be purchasing, let's say, 6 months, 3 months, maybe sometimes a year, and might not be able to get some of that premium back. A lot of times those are, what they call fully earned policies, where they keep all the premium regardless of how many months you guys are using. Like I said, within the program, it's a month-to-month deal. So really, hey, if you, only need the insurance for 2 months, then that's all you pay for. If you get for 6, you can continue it. And you don't have to worry about, those time periods. You can have the insurance for as little or as long as you need it.
Okay, so can I break that down for everybody? Because that was a lot of information, and I need to help you guys break it down, okay?
Yeah.
Some of you may not hear all of it. Okay, let's break it down. Vacant property, okay? This is when you renovate the house, and it's sitting on the market. How many people have that right now? Okay? Very, very few, if any, insurance companies, your State Farm, Allstate, local, Geico, whatever, will not insure a vacant property, okay? Very difficult to get, all right? And in fact, they're the only ones I do know that get it, okay? It's not a very astronomical premium either. It's fairly reasonable to what a typical homeowner's policy would be, okay? However, if your property is vacant more than 30 days, they will automatically invalidate your insurance on any other policy. That's why this is so important to have a vacant property insurance. Have the right type. You don't need to play games, okay, as far as the price is going, because they're all fairly reasonable prices in whatever category, but make sure you have it for the right thing. Sometimes we use it for a buy and hold strategy, okay? And that's where the landlord-tenant policies come into effect. They have it as rental property because it's different. And the difference is, and feel free, BreAnn, if I'm saying anything incorrect.
Sure.
When you get a landlord-tenant policy, how many people have ever gotten that? okay? If your tenant is out more than 30 days, how many times have you had a tenant and it takes you 3 months to lease up a piece of property? I mean, come on. That's the real world, right? That will invalidate your insurance policy. A landlord-tenant policy is a great policy if you have it rented every single month. How realistic is that for us? I mean, it's typical that a tenant will leave and it might take 2 months, 3 months. I've even had 6 months, that's really rare, where it takes them to lease up, okay? They're giving you 60 days, is that correct, BreAnn, on that?
60 days before you need to change the occupancy status. And then beyond that, if you still need coverage, of course, then it's as simple as just changing it over to a vacant location. So it's not like you lose your coverage isn't limited or reduced in any way. It's just a matter of changing that occupancy status. The premium, of course, does go up a little bit because now we're into a little bit higher risk with it being vacant. Just as the same is true, with those that are on the market for sale that are vacant as well. But at the same time, you're correct. You have up to 60 days to, really just find your tenant, not have to do anything about your insurance. And then, beyond that 60 days, it's just as simple as an occupancy, status switch.
Okay. Let me just take a few questions we have. Dennis, do you have one?
Yeah, quick question. Do they insure properties in either Florida or Texas?
Yes. He's asking, do you insure in Texas and Florida?
Yes, we certainly do. And you can insure Texas and Florida coastal. You can insure either with or without the named storm or hurricane. So you can decide, if you want to include that hurricane coverage or not.
Okay, just so you guys understand that part, because the clarity may not be there. You can get coverage insurance in coastal areas of Florida and, Texas as well. However, and you can have it with a named storm or without a named storm, okay? There's a difference in the price and the premium, okay?
Yes.
And yes, risk is relative to reward there, so it will be a higher premium for the ones with named storms as well. Like Sandy was not a hurricane, right? So it wasn't covered, but it's a named storm. So it would require that kind of premium.
Right, correct.
Can this be a policy on top of a regular homeowner's insurance policy? In other words, if the tenant moves out and you realize that it's going to go longer than 30 days and your existing policy won't cover, can this be an additional coverage on top?
Well, his question, BreAnn, and I think I can answer this in regards to that. He's asking, could you use it as an additional coverage to it? Here's my thought, guys. Why buy two types of policies when one could cover it? If you're going to go over 60 days, all you simply do is log into your account and change the status. Your rate goes up minor. I'm talking remember, they bill monthly. They don't bill like you have to pay the policy premium up front. If they say it's $1,100, you don't have to pay that $1,100 up front. They'll break it down to monthly installments that are reasonable.
Right. Right, exactly. It truly is a month-to-month, and it truly is, just a simple, status change. So you don't have to, in the standard market, you're always having to, if you want to do that, you'd have to essentially have one policy cancel and then start a whole new policy for that property location. The way that it works within the program is that we set up an account for you, and then you actually can see on a monthly statement basis the locations that you have insured with us. Also, all of their main coverages, coverage amounts, deductible, that type of thing, and the cost broken out per location. And then it's as simple, like Melissa said, is going into just our easy web link to make a status change, or even adding properties or deleting properties from, that account that you have with us. So it's very simple. You don't have to start a whole new policy for each particular location. It's as simple as adding a location onto the account that you already have.
Yeah, I have their insurance, just so you guys know. I do it on my renovations, okay? And when I have the vacant properties, then we just change it over, okay? So it's just a simple notifying them. It's easier just to do it on their website. It's much easier. Ross?
Is this strictly for residential properties or it can also cover commercial?
Can this be for commercial properties as well?
Commercial properties, we do have coverages for. If you need to have it billed on a month-to-month basis and you already have like a whole schedule going, we can add that right on. It's still going to be probably with a different carrier than within the program. We would all, set that up with a more of a standard type of policy that would be most appropriate for it. But there is a way to bill it through the program so that you're not having to pay, let's say, for your single-family home through the program and then paying it a separate, direct to the commercial carrier.
Okay, they do have it. This would be like almost like a separate division, because it'd be different carriers. These are the 1 to 4 families. Okay, 1 to 4 families would be covered under the topic that we're talking about tonight. Go ahead, Carl.
Does she offer anything on new construction?
On new construction, would renovation count as new construction, or do you need a separate policy?
No, we can also do new construction within the program as well.
Okay. We didn't highlight it tonight because most of us don't do new construction, but yes, they do offer it, and you can get their rates for that. Well, did somebody have a question over here? I saw a hand.
Question, typically the board, they don't allow you to break down the changes.
They break it down in Florida. Yep, in Florida. BreAnn, in Florida, you do the same type of program. It would be month-to-month basis, correct, for the payment?
Correct, yes. It doesn't make any difference what state you're in, and this is a great point to bring up. No matter where you're investing, you can still have everything all on that same schedule. So if you were investing in multiple states, you could have properties in Missouri, you could have properties in Chicago, you could have properties in New York and Florida, and all of those locations can go onto that one master schedule, if you'd like to. A lot of people do great things about per LLC, if that is, suits them best. So there's a lot of flexibility is what I'm trying to say. But, you certainly can, do multiple states all on one same schedule, which makes it extremely easy for you guys to manage.
Yeah, do you understand that? So you can have multiple cities, multiple states, and you just go in there and monitor your premiums. Whatever. If you wanted to leave, you sell a house, you do this. This one's a buy and hold, this one's a renovation. Every state, all 50 states, right?
Yep.
All 50 states, okay? So, hopefully that answers the question.
Alaska and Hawaii, too. I think we have about 2 locations in each of those states, but we do them all.
Are there exclusions for condominiums?
No, not at all, actually. Condominiums, they actually do that a little bit different basis, too, just considering that you guys, are only in that particular case insuring the interior. So there is a way to insure those properly, and it doesn't matter if it's, condominium that's in the style of, let's say, a condo-style condominium, or if it's more of a townhome, where you still have an association there, either or. So no restrictions there whatsoever.
So, great. So you guys understand, rental is different from the landlord-tenant policies that most insurance companies have, because they allow the rental for 60 days. The other benefit is God forbid there's a fire, they will pay the rent up to 6 months, is that right?
Yeah, if you opt to do loss of rent coverage, that's a coverage that is, a standalone separate one that you can either choose to have or not have. But that's also another benefit to mention too, because the loss of rent coverage and also other structures coverage, which would be like for a garage, is always usually automatically included in the standard market as a limit, so you pay for it whether you want it or not. Or if you don't have a garage, you're still paying for it even if you don't have a garage. So the loss of rent, getting back to that, you can add it. All we need to know is just that monthly rental amount. It does pay out up to 6 months in the event of a covered loss that you have. If you have to move your tenant out, then it will reimburse you as you sustain that loss. So month one, you'll be reimbursed for that loss rental income. And it's very inexpensive as well, that particular loss in rent income. It is typically runs anywhere from, let's say, $1.50 to no more than $5, usually, just depending upon your rent. It usually is around $2 or $3 per month on the average.
I was just gonna say, on my year policy, it was $12 for the rental.
Right.
Guys,
Right.
that's silly. If you have a mortgage, make sure, and you do have to ask for it. You want loss of coverage for the rentals, okay, for covered losses. So just make sure you ask for it, okay? It's a great feature to have, especially if you have mortgage. We have another question, Alina.
Does she carry ordinance of law?
Do you carry ordinance of law?
Ordinance of law. That particular coverage we don't have at this particular time. We might do that sometime in the future. We just haven't really had a huge demand for it from our real estate investors. So at this time, we don't have it.
Let's get into the renovation insurance. Is that builder's risk policy?
Correct. Mm-hmm.
Many of you guys, when you ask for a builder's risk policy, when you go to your local mortgage insurance agents, they will require you to pay for the premium up front for the year. You sell the property in 6 months, and you never see any of that money back. Okay? Is that correct? And many of you guys have builder's risk. I've paid plenty of policies, and I sold the property in half the time, but they don't give you the credit for the money. Every other policy, they usually do. In this case, they do prorate it monthly, okay? What's nice is that if you sell it in the, if you buy it in the first of the month, they just do it for the whole month, cover for the whole month. So that helps if you're, like I'm having that with Oak Street, right? I'm covered up to the end of the month for the selling. I bought it on the 8th of the month, right? I close on the 8th. Right. I'm actually going to sell it on the 25th. For those 2 weeks, they're going to cover me for the policy. So
right, exactly.
Right.
So, exactly. And Melissa, that's another good point to bring up too. You know, something else that we've sort of simplified within the program is that proration. You know, we found that was really cumbersome for, you know, our real estate investors, just in terms of the way that it's usually handled in the standard market where, you know, there's the counting of days. And then also, you know, just it gives everybody a lot of headaches because you guys are trying to figure out, hey, did I get the right amount of premium back or what have you? And so we really just simplified that to, you know, you really just pay for any, you know, any locations that you have on the schedule for that month. And then if you are selling that month, like you said, you don't pay for that month. So whatever is on there at the end of the month, you pay for, and whatever is gone by the end of the month, you don't.
Okay. So that's a nice little plus there too. You don't have to. It's not per day. It's for the end of the month. Okay.
Right. Exactly. So you can know, hey, if I started coverage, you know, let's say today on the 9th, then you know you would pay for the full month of July, but let's say you sell it in 2 months, and we're in September, and you sell it on September 20th. Then you don't pay anything for the month of September, but you still get that coverage up to September 20th.
Just because of time purposes, I really want to concentrate on, can we go over actual cash value versus replacement value?
Absolutely. That'll take us about 2 seconds here. The basic, you know, main underlying difference between those two things, replacement cost and actual cash value, is whether or not you get to recoup any depreciation that you have in terms of the claim settlement. So, you know, whether you have, let's say, they care that it's a kitchen from 1970 or it's not. So in terms of the replacement cost, that type of a policy and that particular one, you actually do get to recoup any depreciation that's taken off that claim settlement. So let's say you do have a kitchen from 1970 and, you know, you have a kitchen fire there and they say, okay, well, we're going to take, you know, $10,000 off for the depreciation for the fact that it's kitchen from 1970 instead of kitchen from 2013. In the event, they go ahead and let's say, you know, you get your first payment for that claim settlement, and then you say, oh my okay, well, I ended up spending, $5,000 more bucks than the first payment that they give me on the settlement. You can actually, if you have a replacement cost policy, go back and say, hey, here's my proof that I spent that additional $5,000, and then they'll go ahead and, of course, cut you that check, that second check to reimburse you for that additional $5,000 that you spent. So that's really kind of the main difference. Now, there is some misconception sometimes because a lot of, real estate investors will equate those terms, that replacement cost and the actual cash value, with the way that they do business every day within the real estate market, and the way that it's defined in insurance terms is just slightly different. So when you think of, actual cash value and replacement costs within terms of insurance, think of, the ability to either recoup that depreciation or not, instead of, hey, what the property is either worth today, which is sometimes equated to that actual cash value, or replacement costs, where people are thinking, hey, this is certainly going to replace my property, no matter what the cost of it is, which is a misinterpretation. That limit is always, that limit of insurance, which is, let's say if you insure it for $100,000, they're not going to pay over $100,000. So even if you have replacement costs, they'll think, hey, if it costs me $125 and I only have $100,000 worth of coverage, they're not giving you your $125, so don't mistake that there. So do definitely take into consideration, hey, if I really need to make sure that I can pay for things on today's costs and replacement costs, making sure that you have that type of coverage is the way to go. And the way to do that in the program is very simple. It's just simply, if you insure something to $65 per square foot or greater, then you've got that replacement cost coverage. So, for example, if you have a property that's 1,000 square feet and you insure it for at least $65,000 worth of coverage, then you've met that replacement cost requirement and you can recoup that depreciation.
Okay, so does everybody need a little bit more explanation on that? Okay, so basically there's two types of insurance you can have. One is replacement coverage or cash value, right?
Correct.
Okay. And basically, don't be fooled of the name of it. Replacement cost doesn't mean what it actually costs you to replace it, okay? Understand that is not what they view in terms of in insurance. They view it as whether we're going to depreciate it or give you the real the cost value of it at $65 a square foot, okay? That's pretty much how they're looking at it. So basically, if it's, you use the example of a kitchen that was from the 1970s, well, they're going to depreciate it off of, today's standards. It's not a kitchen that you had from 2013. The nice part about replacement coverage is that if it costs you more, up to the policy limit, you can request the depreciation amount. Am I correct in saying that?
Yes, correct. So they'll first do, for any type of claim, they'll first do the actual cash value settlement. That'll be the first payout that they'll do. And then the difference is, like you said, if you have a replacement cost policy, you can come back and recoup that depreciation that they subtracted initially.
Okay. So they're going to give you the actual cash value with minus the depreciation. And then if you have replacement coverage, they'll give you back the depreciation. Okay? That's pretty much how it would be. Okay?
It's like guaranteed replacement cost?
Is that guaranteed replacement cost? It's not. That's what we want to be careful of. It's not what it costs you to replace it. Because you can do.
There is insurance you can buy guaranteed replacement cost.
Right. You can. There are policies out there that are called guaranteed replacement cost policies. And there's a difference. There's definitely a difference. You guys gotta watch out here. When we're talking about replacement costs within the program, it's not guaranteed replacement costs. The limit is whatever you set that coverage amount to, at. So if you choose, for it to be $125,000 and it costs you $135,000, that backs on you $125,000.
Right. It's up to the amount you guys insure it for. So if you put $125,000, she's saying, that's what you'll be capped at. You're guaranteed up to that amount.
What was the $65 thing you put in here back here?
Oh, the $65 a square foot covers you up to replacement cost, is that right?
Where are you gonna build the whole island for $55?
That's, what's that?
Where are you gonna build the whole island?
Well, here's the thing, you own the land, you own, yeah.
Right.
Yeah, that day.
I was like, about 50, 200.
No.
About
There's a wrong
$100.
We built in 65. 65.
Lot of constructions at 350, so I don't know where that 55 comes from.
You're getting too much of a share.
Is there a different dock there that would be allowed? Is it 65 is set by the
Oh,
engineer?
yeah, absolutely. $65 per square foot, by the way, is just simply the minimum that's required in order to get that replacement cost benefit. So if it makes more sense in your particular area, if you're, really concerned about, hey, at the end of the day, this is a property that I really like, it's a great cash cow, and if something were to happen to it, I really would want to rebuild this property, then, you really want to insure for that full replacement value. Don't just stick to that 65 and say, if it's going to cost you $85 per square foot to replace it, and you want to make sure that you're covered for that in the event of a total loss, then by all means, insure it for that $85 per square foot. The 65 is really just, benefit you guys as investors, as Melissa was saying, obviously we don't have to put the land value in there, and also it's kind of in recognition of the fact that most of the time you guys do have better resources for discounted labor and materials, but they're not forcing you to, let's say, $85 per square foot or $100 per square foot in order to get the replacement cost benefit. Whereas in the standard market, they would say, hey, even to get that replacement cost benefit, you have to insure to at least $85 or $100, or let's say if you're in California, $150 per square foot to get that benefit. In the program, they've lowered that to that 65 as the minimum. But by all means, like I said, if it's more appropriate for you, if it's a great property, and you need to make sure that you've got that true rebuild cost, God forbid the thing burns to the ground, by all means, don't keep it at the 65. Just use that. That's just a minimum marker.
Okay, so everybody understands, that's the minimum marker. If you want to insure the house for $375 a square foot, then you pay for that premium at $375.
Yep, good for it.
Okay, so you can set the dollar amount that you want. So if you're building in Lloyd Harbor, which is going to be about that, that's a very, very wealthy area, you need to build that price point. But the minimum will accept. And the reason why this happens, guys, I've had a policy on my primary home policy. I know, John's a contractor too. We can build that house for $250,000, but they're making us at a minimum insure it for $375,000. Okay, so they're setting the bar as to what the price per square footage is. So that's what I'm trying to express, is that they're taking it as minimum. You can set what you want.
Correct. And the other thing I would add to that too, with the actual cash value marker, that particular marker is set at $45 per square foot to eliminate co-insurance out of the mix. And so there might be, of course, accordingly other properties. So let's say you purchased for, putting, 40 into it. So you're total all in at 55,000, then in that particular case, you're not having to insure to replacement cost if you don't want to. If you're going to flip something around quickly, which a lot of our guys who are doing rehab, all they're really mostly concerned about is, can I just at least make sure that my total investment is covered? God forbid the thing burns to the ground. I at least want to make sure that my $55K that I put into it, I can get back out, which you can certainly do. And the great thing is in the standard market, you can't really do that because they're going to force you to that replacement cost number no matter what, for the most part. Whereas within the program, $45 per square foot is a good number, because then what that does is it ensures that at the end of the day, if you had a total loss, thing that burned to the ground that was that $55,000 property, and let's say 1,000 square feet, so we're above our $45 per square foot, then at the end of the day, you're not walking away from the table with $20,000 25 like you would in the standard market, or God forbid, maybe even 10, because they're penalizing you all over the place for not being insured to a high enough value. That's the smart walking away from the table with your 55.
That's important, guys, especially if you have private money on there. You have to protect your private money is money. So you have to make sure you're just, you don't have to overinsure, but you just have to make sure your minimum is covered, which is your private lenders, your lending capital. This is a great way to raise capital if you know your insurance and how they're protected. Okay? It's very important.
If you have multiple properties insured with them, is there a special rate that you can get with them?
Trust me, already the rates are very good. It's very, very favorable. I insured a house that was, 229, right? And what am I paying? I think $112 a month. I mean, it's very minimal, and I have what I need, the actual coverage I need, and I'm insured up to $250,000 when I put 225 in. So it's definitely. Oh, I didn't even put that much. I think I put 119 and 60. Yeah, like 180. I had it into that. So it's very reasonable, guys. It's very, very reasonable insurance. Okay, we could go all night with this, and I know we have to touch on one thing, but I wanted to make the introduction, okay? Because a lot of us are very confused about the insurances. And the more I hear the stories about, oh, I have big insurance and I'm paying for a premium that you know is not going to cover it, this is the benefit of having these type of insurance. So what I'm going to do is, BreAnn, can we write down your contact information? We're going to send it out to you guys. Can you put it on the screen, actually, so that they can write it down?
Yeah, certainly can. Let me go to.
The website's very effective. Let me give you some personal tips. What's that? Nice and big, they want it to be. Very big.
Let's see if we can, let's make it very big, shall we? Let's make it twice as big. Let me see if we can do that.
Let me just tell you guys.
Oh, there we go.
Look at that. There you go. That's what we needed earlier.
Okay, we're going to send it out in an email blast, you guys. Would you like that too?
Yeah.
Okay, all right. So we'll send it out in the email blast. This is really important. Everybody who has insurances should really check their policies. In-state, out-of-state, whatever it is. If you're doing renovation, guys, I'm telling you, their deductibles, we can get into this, $3,000, $5,000, and $10,000. On rehabs, guys, I usually try to do the max. I'm just trying to give you my own personal tips here. It's not licensed or sanctioned by any means. It's just my own personal experience. If I'm doing a rehab, I usually ask them a higher deductible because my premium's lower. I'm holding the property for a short period of time. I'm already doing the renovation anyway, so if something comes up, I'm willing to fix it while it's being fixed anyway. My landlord-tenant policies or my rental policies, I usually go lower on my deductible because they're a longer-term investment for me. So you can pick them. 3 and 5 is usually where I stay around. I believe there is a $1,000 deductible on builder's risk. Is that right?
No, we don't. We stopped doing the $1,000 deductible when sort of the market crashed, and the carriers actually kind of, it was either kind of one choice or the other, which was either we can raise, the rates and go that direction, like a lot of people did at that particular point in time, or we can kind of restrict the deductibles a little bit and make the lowest deductible a $3,000 deductible. Given the fact that most of the time you guys pretty much handle anything that's below that anyway, and then that keeps your premiums lower, and also, throughout the life of the program, from my experience of being here now 5 years, I've only seen rates, decrease overall nationwide. Now, of course, there's some, different things that happen on the coast. That's always kind of different from year to year, as you guys know, who invest there, depending upon hurricanes and that type of thing. But like I said, for the most part, our program rates have decreased where we've seen increases in the standard market. So having that deductible that really is just $2,000 difference really does make a difference, on the overall pool for everybody. You're not saying, hey, well, why did my rate go up this year? I didn't turn in any claims. Well, it's because everybody else turned in a $1,500 claim, and so they've got a ton of them out there. Where there are other people who are saying, hey, just really, I'm going to utilize this, but if it really is going to hit me, if I have something that's let's say it's, $5,000 loss or $7,000 loss or $25,000 loss, as opposed to those $1,500 losses. It really does make a difference, for that rate stability for everybody long term.
I agree. Guys, when you're putting insurance claims as investors, try to put as minimal as you can. I mean, it's got to be something that really is going to hurt you. Putting out a little bit out of your pocket, $1,500, $2,000. I mean, that really, in the scheme of things, in the whole project, shouldn't be a lot. And I would really encourage you not to put in those kind of claims. Just cover them in your rehab cost or your buy and hold strategy.
What's the liability limit?
What's the liability limit?
Great question. Liability limit for the program is $1 million per occurrence, and it's a $2 million aggregate for the year. So kind of a generous limit there. And Larry will talk on that liability piece as well. Which, by the way, if there are particular investments that you guys have, that maybe you have a little less, skin in the deal, and you would just want to do a liability-only coverage, that's available in the program as well.
Okay, so there's a lot of different options. I want to encourage you guys to look at whatever investments you have. Another personal tip is that if this is your first closing with them that you're going to use them with, I encourage you to call them or process your insurance a day or two at least before the closing. If you know what's going to happen, the closing is going to happen on Thursday, do it on Monday. Prepare yourselves, okay?
Yes. And then that way we'll have time, especially at the beginning, if you're new to us, to, go through those different options, because the program is so flexible and we can really tailor it to something that really does fit your specific need, as opposed to the standard market where, you kind of have more different cereal boxes that you can pull off the shelf, but that's about it. Let's talk about what makes the most sense for you.
Yeah, and the other thing is it takes 24 hours for them to send you a policy back. I mean, they put a rush on it for me, and they got it that same day, but don't put yourself on that gun, especially if you're an investor. Give yourself the time, okay? The fact is, I went to a closing, I forgot to actually get the insurance. I had a private lender, I can't believe the attorney, him, none of us. We all forgot. And it was great because I was an existing client with them, they backdated it the day of the purchase, and that's like 5 days later, remember, okay? So that's a really nice feature too, okay? Not that I encourage you to get insurance, because that's not a really wise thing to do, but the fact that you have it is the right thing, okay?
Yes, so. True. And one note about that, just if you have an account up and running, it does relieve some pressure from you guys. It really does give you about 30 days, where you can put coverage into place.
Yeah, I can actually close on, July 5th and remember to put my policy into effect on July 28th and be covered for that whole month, okay? That's what establishing the relationship is with them. So that really helps. Again, I don't encourage it because you don't want to get in that bad habit, but it's there if you need it. It's a cushion, okay? So I encourage BreAnn Stephenson is the representative I've dealt with over there. This is her contact information. On behalf of everybody at Long Island LIREIA, I think there's about 80 or so of us here tonight. I want to thank you so much, BreAnn, for doing this. I'll be in touch with you shortly when you do on the phone.
That sounds great. Thank you so much, and you guys have a wonderful, wonderful evening, okay?
Thank you. Okay.
Bye-bye.
Bye.